Alex Hall for Morningstar. Coal is one of Australia's key exports, and Whitehaven coal is a key producer and export. It's also in Morningstar's Best Ideas list. To discuss its fortunes and its future, we're joined by Managing Director and CEO of Whitehaven Coal and by Morningstar analyst Matt Hodge. Hodgie, let's start with you. What is Whitehaven Coal and why is it on the Best Ideas list?
Yeah, so it's a coal company. We've been covering it for a while. Mainly produces thermal coal. It's got a few operations in New South Wales, a relatively low-cost producer. Really, the coal industry is not making money at the moment, and that's reflected in the share price. There's a lot of concerns about the outlook, and we think that's kind of been discounted in the shares, and we think the market's probably being a bit unrealistic in its outlook for the future for this business, and it's trading at a steep discount to our fair value estimate. So that's why we're here, and that's why we're talking about Whitehaven Coal.
All right. Paul, let's turn to you. Welcome to Morningstar. Thanks for coming along. Let's talk about the results first. It was a bit of a rough result, and the shares have sold off since then. That was sort of late August by about 30%. What's your take on how the market reacted to that?
Yeah, look, I think it was a tough day, and the subsequent days have been tough trading also for the stock since that time. Look, I think the concerns are more about the outlook, really, not so much the numbers we printed. And although it is a large transition from the previous year 19, which was a record on the high level, and you feel like very quickly we're back at the low levels of a trough in a relatively short space of time. But I think it's the outlook where most people are focused with their concerns.
And it's been a year like no other, obviously.
Well, there's been much to do in our business, I can tell you that. It's been it had ongoing droughts, which have been very severe and difficult for us. But we dealt with that without stopping production at all right through that drought, which was great. We actually had some flooding rains, unfortunately, in February, which was great to bring water supply back into the region for everybody's purposes. And then, of course, COVID on top of that, which is quite extraordinary. So, you can imagine what January seemed quite normal, although COVID was in the background. February started to ramp up. By the time March came around, everybody was scrambling, how do we keep our operations going and manage the risk of infection and so on in our operations and the community more generally.
And Matt, what about you? How did you see the market's reaction?
Yeah, I think there's a lot of concern about the outlook. I mean, that's predominantly where the share price action is. And with the coal price where it is, the company's not going to make a lot of money this year. But I guess it's about, what are you paying for? And you're paying for a future earnings stream that's not just a single point in time. So I guess that's where we would disagree with the market. So yes, there are some concerns. I think, balance sheet is probably a primary one, and we'll talk about that. Sure. But, this business was in worse shape in 2015, in my view, and it's got a more productive capacity and better ability to earn its way out of the debt position that it's in. So, I think given then, and they didn't need to raise capital in 2015, I think the odds, favour upside from here.
Okay. Paul, on that, are you being conservative? Do you see any upside to either unit costs or volumes?
Yeah, Lex, I think the market reaction to our guidance has been, less enthusiastic, and I think these are times when a little bit of conservatism is warranted. Yeah. The outlook is uncertain. You'd be a bolshy bunch to put some sharp-edged guidance out, and so we have taken a conservative position both on volumes and costs, and I think that's the right posture to have at this time, because there are some moving pieces here, and nobody's crystal ball is working exactly as they'd like it to at the moment.
That's right. All right, well, let's turn to the balance sheet. Debt is pretty high right now, and that's unfortunately corresponded with the downturn in the coal price. How confident are you that Whitehaven Coal has sufficient funding to weather this unprecedented downturn?
Yeah, look, it's fair to say that there's a lot of focus on the balance sheet capacity, and our liquidity at the moment is just under the $500 million mark between our drawable capacity from our facility and cash in the bank. So that's a lot better than the last cycle, as Matt's referenced. So we feel much more comfortable that we've got, as you say, a bigger production base with which to earn our way out of this. And we're doing all the things that you would expect us to do at this point in time in terms of metering out the capital very parsimoniously, obviously screwing our cost base down as quickly and as hard as you can without doing any damage to the long term. All those things will see us through this period, and our view is that we don't need equity. And so we're quite comfortable in that regard. The banks are very supportive.
I wanted to ask you that. Have you had any lenders sort of step away from coal?
Look, no, we refresh our facility every 2 years. We go through an amend and extend process, and we did that just in November past. So add another 2 years onto our facility. It's out to July 2023. The group there has been very supportive, so we're very pleased of the continuing participation of all our members of our syndicate. We have allowed over time, our view has been that we need more Asian banks in our syndicate over time, so we've allowed them to step up in proportion.
Okay, because they're your key customer.
There's great symmetry between our business and the Asian markets. You know, we've got joint venturers there, we buy gear there, we've got most of our sales going into not just North Asia, Southeast Asia as well now. So the symmetry there is very obvious for us, and a banking and insurance relationship on top of that makes great sense. Okay.
Hodge, what's your take on the balance sheet?
Yeah, I guess like I said before, I think the company's in a better position than it was. And I think, you know, $50 coal is very difficult for the whole industry. You know, if that's to stick around, then I think we're going to see a pretty meaningful supply response. So, you know, I think there's upside in the earnings from here. I think there's enough capacity to get through, and they're in a better position than 2015. So I think odds, you know, say it's unlikely you're going to need a capital raising.
Matt, you mentioned the coal price is now at US $50 a tonne. Paul, let's turn to you. That's a cyclical low, if I'm not wrong. What got us to this point?
Yeah, we're comparable to that 15-16 low. Between $48 and $52 we seem to be gyrating. Today's 52. Back at that period, it got down to 47. Okay. Currency is at 73. That's actually higher than what was at that previous corresponding trough. What's got us here? Well, I think that the primary consideration, firstly, was you've had a lot of cheap gas in the marketplace, and that's pre-COVID, of course. Right. And that's a product of slowing activity, but more production. Now, the US in particular, you've had lots of gas production there as a byproduct of the shale oil pursuit. That's got us to there. And then you've got now concerns with lowering demand. And so as economies like ours, our customer economies are slowing. And so that's certainly brought about a moderation of demand generally. China being one of the biggest players in this is an important piece of the puzzle. Now, Whitehaven doesn't sell to China. Right. Our quality is too good, but it does affect us indirectly through the price. So if they're not drawing out of the seaborne market the way they normally do, and they are not at the moment, then that means there's slackness in the market, some surplus coal that needs to find a home. And whilst it doesn't compete with our quality, it does create downward pressure on prices, is what we're seeing.
Who are your biggest customers?
Our biggest customers, Japan, Korea, Taiwan, and India. If you threw a blanket over them, that's 85% of our business. Right. So Japan, Korea, Taiwan, very well established. India coming to the fore now, our largest single met market. Right. But in the last 12 months, you've seen expansion into the Malaysian market, Vietnamese, and the Philippines. Yeah,
right. So we should specify you're selling thermal coal, which is used in production of electricity, and metallurgical coal, which is a key ingredient in steel making.
Correct. Yeah, 80 thermal, 20 met at the moment.
All right. Hodge, as you said, much of the industry is losing money at this current spot price, and we've seen supply reductions. Do you, first of all, I'll ask you this too, do you expect to see further supply reduction?
Well, I think it's going to be some combination of improved demand as economies start to recover from COVID, and also, you know, the industry can't sustain this price. There's too many firms are losing money at this price, so that's not going to continue forever. So I would expect to see closures. You know, we've already seen some in Indonesia, and we've seen Glencore do the kind of things that Glencore's done in the past, where there's been an oversupply and they're cutting back. And I think if that's not enough to solve it, we might see a bit more in that respect. So,
okay. You're nodding in agreement, Paul?
Seeing the same things as Matt's saying, absolutely. So,
and coal quality is obviously crucial here.
It absolutely is. I mean, we've, as a company, our strategy has been to position ourselves at the highest end of the coal quality curve from a thermal perspective that we can. Yeah. We are blessed with very, very good quality out of the Gunnedah Basin, very good. And Maules Creek broadly is the best thermal quality you can buy in the seaborne market. From our perspective, we've not seen any buying behaviour changes at all right through COVID for our coal. We have seen some in the met market because of lockdowns in India in particular. So when the lockdown occurred, it did include the ports. So we did receive some requests to defer sales from the June quarter into the September quarter, which we've accommodated. But those are reinitiating now, which is very positive.
Okay. One of your key assets, Paul, is Vickery, and it got approval this month. That was a milestone. What's your appetite for developing a new coal mine? Have you got the capacity or the appetite to do that?
Well, it's quite a unicorn, isn't it, to have an approved coal mine up your sleeve now.
Yes.
So it's very unique. It's taken a long time to get there, longer than it should have. But we have an appetite to do it. $52 coal as the backdrop is hard for a board to consider pushing the button on that. Yep. We did do that counter-cyclically with Maules Creek when we built that as the coal price was sliding. But times are different. Yep. And the outlook does have some uncertainties to it. So I think there'll be a more measured approach to that. So I can't see us making a decision on that within this financial year. But we're taking that time to keep refining the cost structure of it and get the capital down. We're keen on it. The coal quality is excellent, better than Maules Creek, in fact. Okay. And the market can recall Vickery coal being sold when it was previously in Rio Tinto's hands. And so there's good recollection of the quality there and recognition in the market. We'd like to bring it back. Okay.
And Winchester is another key asset. What are the merits of both Vickery and Winchester?
Yeah, well, Vickery is obviously in our backyard, so another egg in the same basket, if you like, in that regard. Similar quality to Maules in terms of its met and thermal mix. It's got more met and better met than Maules has. So we think it'll be more oriented to met than thermal. Whereas Winchester South allows us to diversify into Queensland for the first time, and also gives us exposure to hard coke for the first time, because in our current assets only produce a semi-soft coking coal, not a hard coke. Right. And Winchester South will allow us to do that. So important diversification for us, and a large-scale deposit in a new jurisdiction, which is very mining friendly in that area. Yep. So certainly worthwhile pursuing. All right,
Hodge, what are your thoughts on the market and what it's attributing to these development options?
I think the market's not really interested in development projects at this point in time, and there's not really anything, I don't think, in the current share price for those projects. And I think in a different environment with different coal prices, those have vastly different valuations than zero. And we think they're worth collectively about 70 cents, and that's risk adjusted. If they make it into production and the coal prices are better, then they could be worth more than that. But, there's a bit of water to flow under the bridge between now and then before I think Whitehaven's in a position to push the button on those things.
Just before we go on, one of the key metrics at Morningstar is obviously the moat rating. We have no moat, narrow moat, which implies a 10-year competitive advantage, and a wide moat, which implies a 20-year. Hodge, Whitehaven doesn't have a moat. What are your justifications for that?
It's not alone in the mining space. We actually don't have any moats on any of the mining stocks that we cover. I think the one real difficulty with the miners is it's very cyclical, and companies can make really good returns in single years, but then you have other periods like now where you're not making a return. It's fundamentally the only way you can have a moat is to be a very low cost producer, and that means you've had a combination of very low capital costs and low operating costs to generate that excess return. And it's just very difficult over that 10, 20-year time frame to get the confidence that those kind of returns can be repeated.
Right. Okay. Turning to capital allocation, how do you weigh investment in the business versus the other options, things like shareholder distributions and, as you talked about, strengthening the balance sheet?
Well, it's a tricky balance, isn't it? I mean, if you look at the 18 months preceding the COVID period, we paid back twice our market cap at the low of last cycle in dividends. So I think we paid $1.10, I think, in cumulative dividends over the period since the last cycle. Right. So you find yourself now, and we've had that earlier discussion just about the condition of the balance sheet and your liquidity there. I think shareholders generally are focused on preservation of that. Yep. I don't think there's a real consensus of views that are looking for dividends right now. I think most shareholders are basically saying, make sure you focus on the balance sheet, keep that healthy. We don't want to see an equity raise, of course, and we don't think that's necessary, but focus on the health of the balance sheet and just ride this through the way you did last time.
Mm-hmm. Okay. And just in passing, you mentioned the coal price being so low about 5 years ago. Did that coincide with when you began?
It was pre that.
Right.
Yeah. I started pre that in 13, so early 13, but it was already on its downward trend during that period, and that was really us as an industry producing too much. And underlying demand was fine, but we did swamp it. I mean, historically what happens here is that you wait for the price signal to come, it takes a long time to get something approved and then built, and invariably that turns up at the end of the cycle. And as it did, and unfortunately, our additions to capacity swamped the underlying demand, which was always solid but hard to see when you've flooded it with capacity. This time around we haven't done that. There's been very little new capacity built since 15, 16. So I actually think this is actually a better trough because it won't take much to tighten it up pretty quickly, and there are quite a few levers there that will play a game in that.
Okay. Hodge, any thoughts on that?
I haven't really got much to add from what I've said before, but it's unsustainable. There's going to be a supply response. You'd expect demand to come back, particularly from those Asian countries where they're recovering from COVID, and then we should see a more sustainable price than the one we've got now.
Okay.
I think you'll see a few other features here. I think supply response is always something that we can control, and you look to see that. You've already mentioned Indonesia doing some heavy lifting in this regard, so they've certainly retreated out of the market. The coal from the Atlantic producers there, that's out of the Asian market for sure, can't sustain themselves anywhere near this price. China's imports have been modest. I mean, they've imported a lot early in the year, and they're very close to their import limit for the year, and they've still got 3.5 months to go. So I would be expecting some relaxation of that import limit as you approach winter, say for instance. Although they do have good hydro capacity this year, it looks like. So that's certainly something to weigh in there. And as Matt's mentioned, our markets actually pretty good as far as in relative terms from a COVID management perspective. I think we all acknowledge the terrible nature of this pandemic, but Japan, Korea, Taiwan, all on the better side of the management spectrum, if you like, of their COVID exposure. And we do expect them to come back to the market in relative unison. And that'll be very good for our business.
Okay. Now, we can't talk about coal without talking about a new term in investing, if you like, a relatively new term, and that is ESG, environmental, social, governance issues. And we've seen these factors come into sharp focus for the past 12 months, especially at Morningstar, but especially in the past week with what's happened with Rio, with some of its key executives having to step down. Whitehaven's has a proud record of employing Indigenous people, giving back to the community and employing a lot of people there. Australia's going through a sort of fundamental rethink on its how it's going to provide its energy. I know you don't provide energy to Australia, but what are the key risk areas in ESG for Whitehaven Coal?
Yeah, look, I think the key thing here is, being in the coal industry does a lot of wonderful things, for the country and for those people who work within the industry. But what it does do, and the contested nature of our space in some ways, is it does focus you on your value proposition as a company to all shareholders, and to all stakeholders, not just your shareholders. And so we've oriented our business very closely around the key stakeholders that matter the most, the ones who host our business. And so we're a local employer. We're not a long-term fly-in, fly-out organisation. We spend our money locally. The Indigenous employment, 9% of the company, as you mentioned, fantastic. That's very, very positive. But you've got to sharpen that value proposition so it resonates with the important stakeholders. ESG is important to us. And tomorrow we launch our second sustainability report, which is a great document which encapsulates not just the ESG, the primary ESG concerns, but our broader view of sustainability and what we're doing about it. I heard someone say your annual report's about what you who you are, but what you did, and the sustainability report is who you are. And I think that's not a bad way to think about it in some ways. Okay. Interestingly, with heightened ESG concerns, our institutional ownership is actually the highest it's ever been. And that sort of seems a little counterintuitive to have, what seems to be the media discourse around ESG-related considerations. You'd think that would be the reverse, but it's not, because I think the quality of conversations with our institutional investors is actually far better than what it was 3, 4, 5 years ago. It's more holistic, more broader. What's the broader proposition that the company represents, and what are you doing to honour those commitments that you've made in your report?
Right, and I suppose another risk in mining is the danger of it, and your safety record has been quite good, hasn't it?
We've had an outstanding year from a safety perspective. Our injury frequency rate is at its lowest it's ever been. That's fantastic. I do think COVID's played a role in that. It's heightened everyone's awareness of safety. And as we've launched new safety measures into that framework, people have responded really well, and injuries have been less, which is fantastic. But it's front of mind for everybody every day in a business like ours, and like no other industry you'll see, I think, really.
Right. And for investors who aren't interested in investing in a mining company, in a coal mining company, because they think it pollutes the environment, et cetera, would your argument be, well, if we weren't doing it, some other company would be doing it and probably not providing as good material? Yeah,
look, I think that the substitution argument, I think, is real. So you can't deny that. If the demand is there, people build power stations, and they are continuing to build a lot of coal-fired power stations in Asia in particular, and they're 30, 40-year investments. And so they're not going to turn it off 5 minutes after they've built it because Whitehaven doesn't want to sell them any more coal. They'll go and buy some somewhere else. So that does occur. And there are 70 different countries in the world that actually have coal reserves. So the best thing we can do is apply the greatest technology when you're building a power station. If you're the power station owner, and you can fuel it with the best coal you can buy, and that's where our coal comes to play. We've got long life assets, which our customers like, because if they're building that long-term asset, it's matched to a long-term fuel source. And in the case of Maules Creek and Vickery, then after, you'll get the lowest CO2 emissions per tonne of coal consumed by using that coal. We're playing our role in that regard. Okay. Hodge, do miners face sort of across the board similar ESG risks, ones that we perhaps haven't mentioned?
I think it depends on, where they're operating and what their particular constraints are. Like Whitehaven operates in New South Wales. It's got a completely different set of circumstances than Rio Tinto in the Pilbara, for example, or Glencore operating out of Africa. It just depends on what the specific issues are around the operations. But I think one thing's pretty clear is that community standards and expectations have been rising in this area. It's not clear to me over time that that's necessarily going to be a bad thing for the industry from a pure profitability point of view, because it does raise the bar to come into production.
And Hodge, I want to finish on a question and get your answer, and then Paul, on industry structure. Do you see a future where coal mining sits largely with pure play coal miners, and that diversified miners are generally out of the industry?
That's kind of what we've been seeing. Rio Tinto sold out a couple of years ago now. Wesfarmers sold out. They're diversified industrial, but nevertheless, BHP's flagged that they're going to sell. So that seems to be the way that things are going. South32's flagged they're going to sell as well, and Glencore's been the exception so far. So it'll be interesting to see what they do longer term, but they seem pretty set on remaining in the industry, and that has traditionally been a pretty big earner for them. But I'd be interested to see what Paul has to say about that as well.
Yeah, look, I think it's definitely an interesting question, because there are shifting sands there, as you've mentioned, Matt. I think there's an ongoing role for a pure play coal company, no doubt about it. I think it's difficult because you're a diversified miner. You're making an explicit choice to be in each of those commodities. Now, if you don't have a competitive position necessarily in that particular commodity, you may say, well, that's actually not core for us, because we're not competitive relative to others who are perhaps more focused on that, say, for instance. And so each organisation's got to make their own choices in terms of what's the best use of capital in their business. In ours, we're a pure play, very proud of that. We've got a good business, and customers love what we do. And customers tell us that you should don't listen to what people say about this industry. And look, we listen to all sources of feedback, but we're very comfortable with it, and we're very confident that we've got a future well into the multi-decades, because that's what our customers need from us.
All right, Paul Flynn, thank you very much for coming along to Morningstar today and for your insights.
My pleasure. Thanks for having me.
Pleasure. And Matt Hodge, thank you for your perspectives on Whitehaven too.
Thanks, Lex. Good to be here.
I'm Lex Hall from Morningstar. Thanks for watching.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.